In today's video, Tom Lee, who is the head of research and chief investment officer at Fundstrat, joined CNBC's Closing Bell to talk about the 2026 market outlook, what kind of volatility investors should be ready for, and how he thinks people should position their portfolios as we head into the next phase of this cycle. And here is the part you do not want to miss. Tom also leans into the idea that 2026 could still end up being a double-digit year for stocks, even with all the uncertainty and headline noise that can shake sentiment week to week. So here is exactly how we are doing this. First, I am going to play you the clip of Tom Lee on CNBC so you can hear it straight from him. Right after that, I am going to give you my honest reaction breakdown, what I agree with, what I think people might be missing, and how I would translate his key points into a practical game plan for real investors. Then after the reaction breakdown, I am going to share an in-depth analysis of 3 of the best stocks to buy with $100 right now, and I am going to explain why each one makes sense, what risks to watch, and what kind of long-term story you are really buying into. And before we jump into the clip, hit the like button. Let's push this video to 1,000 likes. Share it with a friend who is trying to learn the market, and leave your thoughts in the comments as you watch. Also, subscribe to the channel so you do not miss the next important investing update. Alright, let's hear what Tom Lee has to say.
This Santa rally, is it a thing like a fake virtual thing, or is there a fundamental thing behind it?
I think there's actual real stats behind it. The Stock Traders Almanac, the Hirschfeld guys actually have shown that this is a good period between basically the 1 week before the end of the year and the first few days.
But why is it? In other words, I always thought like people around this time are maybe selling stocks to give money to charity, pay bills, those sort of things. I would think there would be downward pressure on the stock market at the end of the year. And by the way, especially on a good year, trying to lock in gains so it's in the calendar for the records.
Yeah. I mean, I could say that I can see window dressing playing a role into year end. Professional money managers want their winners to look good, so they bid them up into the end of the year. And then the first part of the new year, I think, makes sense because that's when people allocate into asset classes. So there's money going into stocks in the beginning of the year.
That's the first couple parts here. I'm an anti-technical person, Kelly.
You don't like the chart stuff?
I don't like the chart stuff. I'm a fundamental guy, and I want to know if there's fundamental stuff. That was the thing. Tom, let's talk about which areas you think for the new year might be areas that are not well covered and maybe ones that are a little off the radar, the sort of, I don't know, the headwind, or tailwind, tail risk things that are out there right now.
Yes, I think in 2026, there's going to be likely a more dovish Fed. And that dovish Fed will allow business confidence to recover. So the ISM, I think, recovers back above 50. And that's going to be a tailwind for traditional sectors like industrials, energy, and basic materials. So I think those are sort of 3 groups that should do better in 2026 than 2025. But then there's also, I think, some tailwinds building for the financial services, which you guys mentioned are doing well, which is that financial services companies are really big beneficiaries of AI, and they're big beneficiaries of using blockchain technology. Both will allow them to reduce their employee intensity of their business. And so I think the large tech-forward banks are going to start to see margin expansion and trade more like tech stocks in the future. Wow. And that's why, the JP Morgans and the Goldmans could actually be the next Mag 7.
Can I just put a footnote question on that? What about the deregulation part? Mickey Bowman over at the Fed has been very busy trying to make it easier for banks relative to regulations. Is that part of your outlook as well with the banks?
Well, that would be a very big tailwind, too. As you know, banks have been strangulated, especially post-GFC, and so it's removing some restrictions would be helpful, as long as you don't remove safeguard rails.
I've seen the market this year, Kelly, trade a little bit on some of the deregulation news. It wasn't something, as the year went on, it got to be more serious, and the idea that they were going to be reducing.
Because I don't read the breadcrumbs carefully.
Oh, God, it's so miserable.
But it's...
I hate covering
bank regulation. It's not like you wake up and someone goes, oh, this earnings report came out, or you wake up and so I'll read an analyst note that says, yesterday in a hearing, this person indicated this, and so it's hard for me sometimes to draw a straight line.
You're so clever about that, because that's kind of the way it happens. It drops in a hearing, it's discussed by a Fed official in a speech, and then it's proposed, and then there's a 60-day comment period, and then they adopt it.
Right. And then
so between and there, it could be like 9 months or a year, and I'm not sure when, but I've seen some of the actual adoption things move some of the stocks in a way that seems to be what Tom is talking about, this idea of thinking about banks having to hold somewhat less capital as the year goes by, especially, by the way, interestingly, I don't know, you went to the regional banks, that they're an area that may benefit more than the larger banks.
Yeah, regional banks, I think, are part of the reason we like small caps, because as interest rates decline and as business activity picks up and potentially M&A pick up, this really plays into the favor of regional banks.
Tom, it seems like you're describing a year next year that could have strong growth but also low interest rates. Are those two things at odds with each other and in tension?
You know, I'd say, I know when people talk about low rates, it depends if they're looking at, you know, long rates, short rates, or even, you know, usable rates. But I do think next year is a year where parts of the economy that have been suffering from high monetary policy rates may actually do better.
He starts with the whole Santa rally question, and the key point is that he is not treating it like some made-up market superstition. He is saying there are actual statistics behind it, and he references the idea that the stretch from about 1 week before the end of the year into the first few trading days of the new year has historically been a strong period for stocks. Now, whether you love seasonality or you hate it, the important thing is what this implies about positioning. If a pattern is widely observed and widely traded, it can become self-reinforcing because investors and managers start to behave in ways that make the pattern show up again. Then the host pushes back with a very reasonable common-sense objection. If people are selling to pay bills, donate to charity, or lock in gains after a good year, why would stocks go up at the end of the year? That is the part a lot of people miss. Markets do not move based on what seems like it should happen in a household budget. Markets move based on flows, incentives, and the marginal buyer versus the marginal seller. Tom's answer is basically window dressing plus New Year allocations. Let's translate that. Window dressing is the idea that professional money managers want their portfolios to look a certain way at reporting time. If you are a fund manager and you own the winners, you want those winners sitting in your book when clients look at the holdings. If you miss the winners, some managers feel pressure to buy them late just so they do not look completely offside. That can create additional demand for the market leaders into year end. Then he adds the early New Year effect. In the beginning of the year, people allocate fresh money into asset classes. Retirement contributions reset. Institutions rebalance. New budgets begin. New mandates begin. A portion of that flow often lands in equities. So his message is that the end-of-year strength is not just vibes, it is incentives and flows. Now here is where the conversation gets interesting, because the host basically says, I do not care about charts. I want fundamentals. And Tom answers with a fundamentals-based thesis for 2026. That is the core of the interview. His big macro call is a more dovish Federal Reserve in 2026. When someone says dovish Fed, they usually mean the Fed is either cutting rates, signaling that it is done hiking, or at least becoming more supportive of growth versus fighting inflation aggressively. Tom ties that directly to business confidence recovering. He then references the ISM recovering back above 50. ISM is a survey-based economic indicator that people use as a quick read on expansion versus contraction, especially in manufacturing. The simple rule of thumb is that above 50 is expansion and below 50 is contraction. So what he is really saying is, in 2026 he expects the economy to look more like it is accelerating rather than slowing. And that shift in the data would support a different set of winners. And that leads to his sector call: industrials, energy, and basic materials as traditional cyclical sectors that could do better in 2026 than 2025. Here is the logic chain behind that, and this is where investors should pay attention. When business confidence improves, companies spend again. They invest in equipment, expand capacity, build, hire, ship, and execute projects that were delayed. Industrial companies tend to benefit from that. Basic materials can benefit because more building and more production usually means more demand for inputs. Energy can benefit if activity rises and demand is resilient, although energy always has its own supply dynamics. But the main idea is a rotation away from a market that is dominated by the same narrow group of growth winners into a broader market where cyclicals participate more. My take on that piece is that it is less about predicting a single sector will explode and more about recognizing what happens when the market stops being a one-trick pony. If the economy is firm and the Fed is no longer a headwind, breadth usually improves. That can be good for investors who are not concentrated in just a handful of mega-cap tech names. Then Tom pivots to what might be the most provocative part of the interview. He starts talking about financial services and basically says banks could become the next market darlings because they are beneficiaries of AI and blockchain. That sounds like a bold headline, but let's unpack what he means. When he says banks benefit from AI, he is not talking about banks launching a cool chatbot and the stock doubles. He is talking about cost structure and productivity. Banks are massive operations. They have huge headcount. They have compliance workflows. They have back office processes. They have customer service. They have fraud monitoring. They have underwriting. They have document processing. AI can automate and accelerate a lot of those tasks. If a bank can reduce the employee intensity of the business, Tom's phrase, it means they can either do the same amount of business with fewer people or do more business with the same number of people. Either way, the profit margin can expand. And margin expansion is a big deal for financial stocks because the market often values them like slow growers with limited operating leverage. If banks start showing durable efficiency gains and better profitability, the market can re-rate them, meaning investors are willing to pay a higher multiple for the same earnings stream because the future looks better. He also mentions blockchain technology as another driver of efficiency. Again, do not think of this as meme coin hype. Think of it as infrastructure, settlement, custody, tokenization, and a more automated financial plumbing system. If pieces of the financial system become cheaper and faster, big financial institutions that adopt the technology intelligently can potentially lower costs and improve services. Then he goes for the big punchline. He suggests the large tech-forward banks could start trading more like tech stocks, and he even floats the idea that J.P. Morgan and Goldman could be the next Magnificent Seven type of market leaders. I want to be very precise here. That does not mean banks become software companies. It means the market could start paying attention to them as platforms with technology-enabled scale, not just spread lenders. It is a re-rating story, not a reinvention story. Now the host adds an important footnote: deregulation. Specifically, the idea that regulators could make it easier for banks relative to the post-financial crisis environment. Tom agrees that deregulation would be a very big tailwind. He uses strong language that banks have been strangulated post-GFC, meaning post-global financial crisis. What he is pointing to is the heavy capital and compliance burden banks have carried for years. This matters because bank profitability is heavily shaped by regulation, how much capital they must hold, how they calculate risk, what activities they can do, how stress tests work, and so on. If rules change in a way that lets banks hold somewhat less capital or deploy capital more efficiently, that can increase return on equity. And return on equity is one of the main things equity investors watch for bank valuation. The conversation then gets a little messy, but the host essentially explains how regulatory changes happen in real life. They show up in hearings, then speeches, then proposals, then comment periods, then adoption, and the whole thing can take many months. The important takeaway is that markets often move before the final rule is adopted. Stocks react to the probability of change, not just the final event. That is why you sometimes see financial stocks lift on what looks like a small regulatory headline. Investors are repricing the path. Then they bring up regional banks, and Tom connects that to why he likes small caps. His argument is that as interest rates decline, business activity picks up, and M&A potentially picks up, regional banks can benefit. Here is the intuition. Regional banks are often more sensitive to local business cycles and credit demand. If borrowing becomes cheaper and activity improves, loan growth can improve. If M&A picks up, deal flow and financing activity can improve. And if rates fall in a way that stabilizes their funding costs and reduces stress, sentiment toward the group can improve. Now I will add my own caution here. Regional banks can be very rate sensitive in both directions, and the exact path of rates matters. It is not just rates down equals banks up. It depends on deposit competition, loan yields, credit quality, and the shape of the yield curve. But Tom is clearly framing a scenario where the pressure eases and activity improves, which is generally supportive for the group. Then the host asks a question that is basically the tension at the heart of market macro. Are strong growth and low interest rates compatible, or are they at odds? This is where the nuance matters. People hear low rates and assume the economy must be weak, and people hear strong growth and assume rates must be high because the Fed has to slow things down. But Tom's response starts by saying, it depends on what rates you are talking about. Short rates, long rates, and usable rates. Let me translate that into investor language. Short rates are basically what the Fed controls directly. That is the policy rate environment. Long rates are things like the 10-year Treasury, which reflect inflation expectations, growth expectations, and term premium. Usable rates are what consumers and businesses actually feel, like mortgage rates, auto loans, and credit spreads for companies. So you can get a scenario where the Fed is cutting short rates because inflation is under control, while long rates do not spike because the market believes inflation will stay contained. In that world, you can have decent growth and declining policy rates at the same time. Another scenario is where spreads tighten, credit becomes cheaper, and usable rates fall even if long rates are not collapsing. That can still stimulate activity. In other words, the relationship between growth and rates is not one straight line. What matters is whether financial conditions are easing or tightening in practice. If inflation is moderating and productivity is improving, you can get a window where growth is solid, but the Fed has room to be less restrictive. Now, if you step back and look at Tom's entire message, it is a coherent story. He is saying the end-of-year strength has a statistical and flow-based backdrop. He is saying 2026 could be supported by a more dovish Fed. He is saying business confidence improves, which supports broader participation. He is saying cyclicals like industrials, energy and materials can outperform in that environment. He is saying financials are not just a value trade. They could be a structural beneficiary of technology, leading to margin expansion and a re-rating. He is saying deregulation could add another tailwind to financials by improving capital efficiency. He is saying small caps and regional banks could benefit if rates decline, activity improves, and deal-making returns. So what is my takeaway as an investor listening to this? First, this is a breadth story. If Tom's scenario plays out, it is not just the same handful of megacaps dragging the index higher. It is a market where multiple sectors participate, and that is healthier. Second, he is pointing to a rotation opportunity. If you have been only looking at the obvious names everyone talks about, he is telling you to look at areas that are more off the radar, like industrials, materials, and parts of financials that could reprice. Third, the bank as a tech efficiency story is worth taking seriously, but investors should watch for evidence. If margins expand because of AI-driven productivity, you will see it in efficiency ratios, operating leverage, and management commentary over multiple quarters. That is what would justify the re-rating. Fourth, the deregulation angle is real, but it is not a light switch. It is a process. Markets can front-run it, but there can be headline risk and delays. So, if you are trading it, you need to respect volatility. If you are investing it, you need to focus on quality operators that can benefit even without perfect policy outcomes. Finally, the rates question is the key risk and the key catalyst. Tom's outlook is basically built on the idea that rates ease without the economy breaking, and that the Fed becomes more supportive. If inflation reaccelerates, if long rates spike, or if growth weakens sharply, the sector leadership could look very different. That is why you do not just blindly buy a narrative, you track the data that supports it, like inflation trends, ISM direction, credit conditions, and corporate guidance. So, if you are thinking about positioning after hearing this interview, the practical mindset is not Santa rally means buy anything. It is understand the flows into year-end, and then think about where leadership could broaden if the macro backdrop shifts the way Tom is describing. And if his 2026 playbook is right, the conversation is going to move from a market obsessed with a small group of tech names to a market that rewards companies tied to real economic acceleration, and companies that can expand margins through technology, including some of the biggest financial institutions that most people still treat like old economy stocks. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the 3 best stocks to buy with $100 right now. First up is Circle Internet Group, ticker CRCL, the company behind USDC, one of the world's most trusted and widely used stablecoins. If you've ever sent money across borders, paid for something online with crypto, or explored the world of decentralized finance, there's a good chance you've interacted with USDC even if you didn't realize it. Circle isn't just another crypto play, it's building the digital payment rails for the new economy, making global transactions faster, cheaper, and more secure. Imagine a world where sending money is as easy as sending a text, and where businesses can settle payments instantly, 24/7, anywhere on the planet. That's the future Circle is working to create. USDC is fully backed by cash and short-term US government bonds, giving it a level of stability and trust that both businesses and individuals rely on. Every USDC token is redeemable for $1, and Circle publishes regular transparent attestations of its reserves. This transparency is a big reason why USDC has become the stablecoin of choice for so many institutions and fintech platforms. Circle's business model is simple but powerful. It earns revenue from interest on its massive reserves, which scale as USDC adoption grows. The more people and businesses use USDC, the larger Circle's reserves become and the more interest income it generates. This creates a flywheel effect, fueling further growth and innovation. But Circle isn't stopping at USDC. The company is rapidly expanding its suite of products, launching programmable wallets and cross-chain protocols that help businesses integrate digital payments into their operations. These tools make it easier for companies to accept, hold, and transfer digital assets, opening up new possibilities for global commerce and financial innovation. As the world moves toward tokenized assets and blockchain-based finance, Circle is positioned as the bridge between traditional finance and the digital future. Banks, payment processors, and even governments are exploring how to tokenize everything, from stocks to real estate, and Circle's infrastructure is at the heart of this transformation. Regulatory clarity is improving, and Circle's commitment to compliance gives it a major edge over competitors. The company works closely with regulators around the world, ensuring that its products meet the highest standards for security and transparency. This proactive approach not only builds trust, but also paves the way for broader adoption by mainstream financial institutions. Think of Circle as the Visa or MasterCard of digital currency, building the infrastructure for tomorrow's global economy. Just as those companies enabled the credit card revolution, Circle is enabling the next wave of digital payments, making it possible for money to move instantly and securely across borders and blockchains. With a world-class team led by CEO 𝗗𝗓𝗓, Circle is solving real problems for businesses of all sizes. 𝗓𝗓's vision and experience in both technology and finance have helped Circle navigate the complex world of digital assets, while attracting top talent and forging partnerships with leading companies in the space. The real opportunity here isn't just in crypto, but in the multi-trillion-dollar global financial system as assets become tokenized. Imagine a world where stocks, bonds, real estate, and even art can be traded instantly, 24/7, with full transparency and security. Circle is building the rails for this new financial reality. Circle's relentless focus on security, compliance, and scalability creates a strong moat that's hard for competitors to breach. In a world where trust is everything, Circle's reputation for safety and reliability sets it apart. Circle Internet Group is currently valued at about $21 billion in market capitalization, but the earnings picture is still in development, with earnings per share at negative 0.86. Even so, the business posted about $1.67 billion in revenue in 2024, and it delivered net income of roughly $18.1 million, which shows there is real scale here, even if profitability and per-share performance still have work to do. For investors, this is a rare chance to own a piece of the core infrastructure powering the next wave of global commerce. As more assets and transactions move onto blockchains, the companies providing the underlying technology stand to benefit the most. Of course, the risk is real. Regulatory changes, competition, and market volatility can all impact Circle's business. But so is the potential for outsized returns as digital assets go mainstream and the world's financial infrastructure is rebuilt from the ground up. Circle is a long-term play. This isn't about quick flips or chasing hype. It's about buying, holding, and watching as they build the future of money, brick by digital brick. If you believe in the digitization of finance, Circle is a company to watch for years to come. Don't think of this as a speculative bet. Think of it as investing in the backbone of the digital economy. Just as the internet needed infrastructure companies to thrive, the digital asset revolution needs Circle. As always, do your own research, dig into the numbers, and understand the risks. But Circle's story and opportunity are simply too big to ignore for anyone interested in the future of finance. For as little as $100, you can get in on the ground floor of a financial revolution that could reshape how the world moves money and value. Let's move to our next pick and see what other opportunities the digital future holds. Next, let's talk about the Trade Desk, ticker symbol TTD, a company that's quietly become the backbone of the digital advertising world. If you've ever wondered how brands get their ads in front of the right people at the right time, the Trade Desk is often the invisible force making it happen. This is a business that's not just riding the wave of digital transformation, it's helping to shape the very future of how advertising works across the internet. Think of the Trade Desk as the stock market for digital ads. Advertisers use its platform to bid in real time for ad space, not just on websites, but across the open internet, streaming TV, podcasts, mobile apps, and even digital billboards. Every second, millions of micro-auctions are happening, and the Trade Desk's technology helps brands win the best placements for their message, all while optimizing for cost and impact. What sets the Trade Desk apart is its independence. Unlike some platforms that also own the media inventory they're selling, the Trade Desk is a pure buy-side platform. That means its only mission is to maximize results for advertisers, not to push its own content or favor its own properties. This neutrality builds trust with clients, who know the platform is working solely in their best interest. The digital ad market is absolutely massive, and it's still growing at a rapid pace. As more of our lives move online, advertisers are shifting their budgets from traditional channels like print and broadcast TV to digital platforms. The Trade Desk is capturing an increasing share of this expanding pie, thanks to its advanced AI-driven platform that helps advertisers make smarter, data-driven decisions. At the heart of the trade desk's offering is its 𝗖𝗢𝗏 platform. 𝗖𝗢𝗏 gives advertisers the tools to target audiences with incredible precision, using data to reach the right people at the right time on the right device. This means ad dollars go further, campaigns are more relevant, and brands see better returns on their investment. 𝗖𝗢𝗏's intuitive dashboard and powerful analytics make it a favorite among marketing professionals who want to maximize every dollar they spend. One of the biggest trends fueling the trade desk's growth is the explosive rise of connected TV, or CTV. As more people cut the cord and switch to streaming services, advertisers are following them. The trade desk is now the leading platform for buying ads on streaming TV, giving brands access to premium inventory on services like Hulu, Peacock, and more. This shift is still in its early innings, and the trade desk is perfectly positioned to benefit as CTV becomes the new normal for television. But the digital ad world is changing fast, especially when it comes to privacy. As regulators crack down and third-party cookies disappear, advertisers need new ways to reach audiences without compromising user privacy. The trade desk's answer is Unified ID 2.0, a new open-source identity solution that's quickly becoming the industry standard. Unified ID 2.0 gives advertisers the targeting they need while giving consumers more control over their data. It's a win-win, and it's helping the trade desk stay ahead of the curve as privacy rules evolve. Financially, the trade desk is a true growth machine. The company has posted years of strong revenue growth, consistently outpacing the broader ad industry. Its profitability is impressive, with high margins and a fortress-like balance sheet that gives it the flexibility to invest in new technology and expand globally. The trade desk's disciplined approach to spending means it can weather economic storms and still come out stronger on the other side. Speaking of global expansion, the trade desk is rapidly growing its presence in international markets. As digital advertising takes off in regions like Asia, Europe, and Latin America, the company is well positioned to capture new clients and tap into fresh revenue streams. The rise of programmatic advertising, where software automates the buying and selling of ads, gives the trade desk a long runway for growth, both in the US and abroad. At the helm is founder and CEO Jeff Green, a true pioneer in the ad tech industry. Green's vision and leadership have been instrumental in building the trade desk into what it is today. He's not just a figurehead, he owns a significant stake in the company, so his interests are directly aligned with shareholders. Under his guidance, the trade desk has consistently stayed ahead of industry trends and out-innovated the competition. One of the trade desk's biggest advantages is its powerful network effect. The more advertisers that use the platform, the smarter its algorithms become, which in turn attracts even more clients. This virtuous cycle makes it increasingly difficult for competitors to catch up, and it helps the trade desk deliver better results for everyone in its ecosystem. In a world dominated by walled gardens like Google and Meta, advertisers are hungry for alternatives that give them more control and transparency. The trade desk is the top choice for brands that want to diversify their ad spend and reach audiences across the open internet, rather than being locked into a single ecosystem. This makes the trade desk an essential partner for any modern marketer. The trade desk's platform is truly indispensable for today's marketers. Its high customer retention rates and sticky services mean that once clients start using the platform, they rarely leave. The company's focus on innovation and customer success keeps it at the forefront of the industry, and its reputation for reliability and results is second to none. The trade desk has a market cap of around $18.63 billion, and it trades at a price-to-earnings ratio of about 43.32, with earnings per share at 0.88. In 2024, it generated about $2.44 billion in revenue, and about $393 million in net income, which highlights the kind of profitability investors are paying for in a premium ad tech name. Now, it's true that the trade desk stock trades at a premium compared to many other companies. But when you look at the quality of the business, its growth prospects, and its dominant position in a booming industry, that premium is well justified. Investors are paying up for a company that's built to last and primed for long-term success. The trade desk sits right at the center of the digital ad revolution. As marketing continues to evolve and more dollars flow into digital channels, owning shares of the trade desk means owning a piece of the future of advertising. This is a company that's not just keeping up with change, it's driving it. For just $100, you can tap into the compounding power of a true industry leader. Whether you're a seasoned investor or just starting out, the trade desk offers a compelling way to participate in the ongoing transformation of the advertising world. This is a stock to buy and hold for the long term, as digital advertising continues to transform how brands connect with consumers. The trade desk's relentless innovation, strong financials, and visionary leadership make it a cornerstone for any growth-focused portfolio. Now, let's look at our final pick. On to Netflix. Our third pick is Netflix, ticker NFLX, the streaming giant that's redefined global entertainment. What started as a DVD by mail service has evolved into a global powerhouse, fundamentally changing how the world consumes movies, TV shows, and now even games and live events. Netflix's journey from a disruptor to an industry leader is one of the most remarkable stories in modern business. With over 270 million subscribers worldwide, Netflix's scale gives it unmatched content power and direct consumer relationships. Its reach spans nearly every continent, making it a truly global brand. Whether you're in New York, Mumbai, or São Paulo, Netflix is a household name, and its influence on pop culture is undeniable. Its original content, from Squid Game to Bridgerton, keeps viewers engaged and builds a moat competitors can't match. Netflix invests billions each year in exclusive series and films, creating a library that's both deep and diverse. This original programming not only attracts new subscribers but also keeps existing ones loyal, reducing churn and strengthening the brand. Netflix has transitioned from a cash-burning disruptor to a profitable, cash-generating leader, even as rivals struggle. Years of heavy investment are now paying off, with the company consistently posting strong earnings and robust free cash flow. This financial strength gives Netflix the flexibility to invest in new content, technology, and growth initiatives. The ad-supported tier is a game-changer, opening new markets and creating a high-margin revenue stream. By offering a lower-priced option with ads, Netflix is able to reach price-sensitive customers and tap into the massive global advertising market. This move not only diversifies revenue, but also makes the platform more accessible to millions who might not have subscribed otherwise. Netflix's data-driven approach means smarter content decisions and more valuable ad targeting. The company leverages vast amounts of viewing data to understand what audiences want, optimize recommendations, and guide content investments. This data advantage also allows Netflix to deliver highly targeted ads, maximizing value for advertisers and enhancing the user experience. Its pricing power allows for regular ARPU increases without major subscriber losses. Netflix has demonstrated an ability to raise prices while maintaining its subscriber base, a testament to the value it provides. This pricing flexibility is a key driver of long-term revenue growth and profitability. The company is expanding into gaming and live events, adding new growth vectors to its entertainment ecosystem. By moving beyond traditional streaming, Netflix is positioning itself as a one-stop shop for entertainment, appealing to a broader audience and creating new opportunities for engagement and monetization. Cracking down on password sharing is already boosting revenue and subscriber growth. By encouraging more households to pay for their own accounts, Netflix is unlocking additional value from its massive user base. This policy shift is expected to have a lasting positive impact on the company's financials. Financially, Netflix is strong, generating billions in free cash flow, paying down debt, and buying back stock. This financial discipline not only rewards shareholders, but also ensures the company can weather economic downturns and invest in future growth. Global growth is just beginning, especially in Asia-Pacific, Latin America, and Africa. These regions represent huge untapped markets, with rising internet penetration and growing demand for quality entertainment. Netflix's localized content strategy and partnerships with regional creators are helping it win new fans around the world. Netflix is now more disciplined with content spend, driving higher margins and profitability. The company is focusing on quality over quantity, ensuring that every dollar invested delivers maximum impact. This approach is leading to better returns and a more sustainable business model. As competitors pull back, Netflix's position as the anchor streaming service only strengthens. While other platforms struggle with profitability and content costs, Netflix's scale and brand recognition make it the default choice for millions of households. The brand, content library, and user data create a moat that's nearly impossible to replicate. Netflix's vast trove of exclusive content and deep understanding of its audience give it a competitive edge that few can challenge. Netflix is expanding into live events and sports, unlocking even more potential. These new offerings not only attract different types of viewers, but also open up fresh revenue streams, further diversifying the business. Netflix is sitting near $396.78 billion in market capitalization, with a price-to-earnings ratio around 39.18 and earnings per share of about 2.39. In 2024, Netflix brought in approximately $39 billion in revenue and about $8.7 billion in net income, which reinforces why the market continues to treat it as one of the strongest, cash-generating platforms in global streaming. For long-term investors, Netflix offers a rare mix of growth, stability, and innovation. The company's proven track record, strong financials, and relentless drive to innovate make it a compelling choice for any portfolio. The days of hyper-growth may be over, but steady, profitable expansion is here to stay. Netflix is now focused on sustainable growth, balancing innovation with financial discipline to deliver consistent returns. Netflix is a business built to last and still has plenty of room to run. With its global reach, strong brand, and ongoing innovation, the company is well positioned for the future. For $100, you can own a piece of the world's leading entertainment platform. As streaming continues to shape the future of media, Netflix stands out as a resilient, innovative, and profitable leader, one that's likely to keep entertaining the world for years to come. There you have it. Circle, The Trade Desk, and Netflix, three leaders shaping the future of finance, advertising, and entertainment. Each offers a unique way to invest in powerful long-term trends with just $100. Which stock excites you most? Let me know in the comments. I read everyone. For more exclusive tips and analysis, join our Patreon community. Link in the description. Don't forget to like, subscribe, and stay tuned for the next big investing idea.